My name is Ankit, and I'm pitching Altria today, and I recommend a long position on the stock. Altria was founded in 1919, and it's headquartered in Richmond, Virginia. They operate in the consumer staples sector with a large focus in the tobacco industry. Key management includes Howard Willard as the CEO and chairman of the company, and Billy Gifford as the CFO and vice chairman of the company. So it's important to note, and I'm moving on, that uh, as the tobacco rates have been falling year over year, the e-cigarette rates have been rising. So I believe that Altria's investment in Juul has been more of a strategic investment because it'll hedge sales risk. So, even if Altria sees that they'll lose sales on their traditional tobacco products, they'll be able to make up for it with these other investments that they're making. Now, moving on to some research reports done by a few companies, Citi has recently upgraded Altria from a neutral position to a buy position as they have more of a bullish outlook on tobacco companies. And this was published just a couple weeks ago, and Adam Spielman was the analyst working on this, and his rationale was that tobacco companies are still going to be stable for the next few years and continue on a positive outlook. The tobacco industry is comprised of a few large corporations who grow, sell, and distribute related products, and the industry is at quite a mature stage in the life cycle, and there are very high barriers to entry in this industry just because of government restrictions and a lot of consolidation. So in terms of how these companies operate in this industry, there's a lot of restructuring, M&A activity to further their market position. Also, branding is huge because, once someone knows a certain product, that's what they're going to stick to. And then the third thing in terms of financials is related to cash flow management. There's a lot of cash flow required to fund ongoing activities. And because of this, they need to have strong working capital. So now moving on to the financial analysis, starting with the WACC calculation, the first component is figuring out cost of equity, which is done through CAPM. So for CAPM, the 10-year U.S. Treasury rate was pulled, which is about 1.77%. The market risk premium, about 6.5%, was also pulled, which is the average over the risk-free rate over the last 10 years or so. And then in terms of the beta for Altria, the Bloomberg adjusted 5-year weekly beta was used. And I feel that, unlevering beta comps and relevering it to Altria's target structure was not too necessary because that's more done for private companies when there's no real starting point and when the company hasn't been able to be seen in terms of a public setting. In terms of the after-tax cost of debt, the last few debt issuances have been looked at, and the rates of those have been pulled and averaged to get about 4%, which is about what I expect Altria to pay on any future debt. In terms of the total capital, the total equity and total debt for the recent quarters have been pulled to calculate the debt and the weight of equity. Now, combining all these factors using the WACC formula, a WACC of 6.13 was obtained. So for most of the modeling assumptions, the past 5 years were averaged to obtain a value, and then that value was compared to analyst estimates for the next few years, and those two values, the historical values and the analyst estimates, were averaged to obtain all these numbers. So, but there are some that I made some adjustments to, such as sales growth. It was expected to be around 1.5 by both historicals and analysts, but I assumed a 1% growth rate simply because it's more conservative in nature, and I feel that that's a lot more feasible, especially with all the negative talk around Juul right now. And in terms of cost of sales, R&D, SG&A, those numbers were all just taken from the averages, which I believe will stay consistent for the next few years, given that Altria is a very stable company. Then at the bottom, you see the WACC, and for terminal growth rate, I feel that since this is a very stable company moving along with the market, I chose a value that was very near to the annual GDP growth as well as the inflation, and came up with around 1.5%. The tax rate, Altria has indicated that they expect to maintain their 24% tax rate for the next few years, which they've realized in the past, and which is an average of what analysts are estimating as well. So using all these assumptions, the model was taken down from sales to gross profit, down to EBITDA, taking out D&A to get to EBIT, and then finally getting down to net operating profit after tax. So the net operating profit after tax is where the discounted cash flow analysis starts. And from there, we're just adding back to D&A, subtracting CapEx, and then subtracting increase in net working capital. So then the WACC was applied to the cash flows to obtain the present value of the cash flows, which is about 41 billion. The terminal value was obtained using the Gordon growth method, using the terminal growth and the WACC to get about 220 billion. And then that was discounted too using the WACC. And both these values were added to get the enterprise value of the firm at about $203 billion. So from here, debt was subtracted, minority interest was subtracted, and same with pension liabilities, and then cash was added, as well as investments in unconsolidated subsidiaries to obtain an equity value of about 205 billion. And then this value is divided by the shares outstanding to get a share price of about $110. So now moving on to the comps analysis. These companies that have been used for the multiple calculation are companies that I feel are very, very similar to Altria in terms of operating activities as well as their financial metrics. For these companies, both a median and an average EV/EBITDA multiple was taken, and ultimately the median multiple was used, which reflects more of a true value. And this multiple was applied to Altria's EBITDA to net a enterprise value of about $130 billion. Then, the same items were taken out as they were for the DCF, which include debt, minority interests, and pension liabilities. And then cash was added back, as well as investments in unconsolidated subsidiaries to get the equity value. And using this method, the share price came out to about $70, which is about a 38% upside relative to the current share price. This is definitely a strong buy, just because looking at the discounted cash flow analysis, the upside ranged from about 62% to 250% in accordance with the WACC sensitivity. With the comps analysis, there's an implied upside of about 38%. So one thing to note is that I personally believe that discounted cash flow analysis can be very skewed based on just a few factors such as terminal growth or sales growth or WACC. And I believe that a comps analysis is much more fair to the true valuation of a company. So I adjusted the value by taking 25% of the DCF value, 75% of the comps, and got an adjusted value of about $80 per share, which is about a 58% upside in relation to the current share price. So, my opposition stock is Imperial Brands, which I believe should be shorted. So just a quick overview, this company is founded in 1901, headquartered in the UK, same sector, same industry, and relatively similar business segments. But my reasoning for why this company should be shorted boils down to three main areas. So one, they have declining operating profit year over year. And, compared to the other top tobacco companies, Imperial Brands' margins are just very low, which creates a lot of doubtful valuations in the eyes of investors and analysts. Also, they have very high dividends, and usually this is a good thing in the eyes of investors, but their dividend payments actually account for 90% of their free cash flow, which results in low funds for continuing operations, which is something that's very important in this industry. And then lastly, on more of a qualitative environmental side, consumer spending has been declining in the UK. People are just buying less of these products due to increased tax regulation in comparison to the US. And I feel that that should also factor into why I believe this company should be shorted. I believe that Altria is a definite buy based on the comps analysis, the DCF analysis for both intrinsic and relative valuations, as well as the qualitative factors surrounding it and the strong presence in the industry. As far as Imperial Brands goes, I believe it should be shorted for the main reasons of lacking in their financials, not having a lot of cash on hand to fund operations, as well as environmental considerations.